Morning everyone, welcome to Ainsley News. It's Thursday, the 20th of January. Shares to fall 30% and gold and silver up from Brigden. Equities markets have painted red all around the world these last couple of days, and again it was the tech growth shares that fared the worst. The NASDAQ is now down more than 10%, putting it into a technical correction for the first time since the COVID plunge in March 2020. Growing fears around central banks removing support are spreading. So why have gold and in particular silver surged? Simplistically, investors have been dismissing the seemingly nonsensical valuations of these handful of tech growth shares that also completely dominate indexes on the basis that fundamentals don't matter. The story goes that fundamentals don't matter because all the new money being injected into the system had to be put somewhere, right? So it makes sense that when they said free money is being withdrawn or more expensive to get, that people start to think about fundamentals again. On the face of it, fundamentals did appear to be getting stronger. Economic growth appeared to be getting stronger, employment tighter, and credit conditions more robust. But then along came Omicron, the effect of negative wage growth amid non-transitory inflation, and of course the prospect of the Fed removing the gear from the junkie. Stagflation is firmly back on the table. Right now, a bunch of indicators are rolling over with GDP reverting off its base effect highs. The January US Empire State Manufacturing Survey collapsing to a negative 0.7 print, its third biggest drop in history. And unsurprisingly, the Consumer Comfort Index is plummeting. Show you a few charts today, and that shows how what's preceded every US share market crash and recessions since the late 80s, and how we're currently primed for something similar. Bring that back here to Australia and apply your own observations on the impacts of Omicron right now. Supply chains everywhere are a mess. Cities and shops are empty. Everyone is hunkering down. The wealth effects of a now buoyant property market are the only juice flowing as inflation outstrips wage growth and more debt. So talks turn to tightening. It is timely to be reminded just how easy financial conditions are right now in the US. The US Financial Conditions Index comprises a weighted bag of financial variables, such as various types of bond yields, FX, and share market indices. It's a multifaceted measure of where the Fed is placing the economy. No surprises, we're coming off an all-time low, the easiest base. Macro Insider's Julian Brigden's latest In Focus report talks directly to this in his typical insightful way. Firstly, he illustrates the correlation between the Financial Conditions Index and the US GDP since the GFC. This from him. I often highlight financial conditions because, as I've discussed on numerous occasions, these, and not the Fed funds rate per se, are ultimately how policy changes impact the broad economy. They're simply too loose. Indeed, if we generally assume that a sustainable trend in GDP growth is as high as between 3 to 3.5%, i.e. half the current rate, then using these charts we've shown previous, financial conditions need to revert to levels last seen in late 2017 or pre-pandemic 2020. The real question is, how is that achieved? In theory, if the pressure is equally spread across all the typical components of a financial conditions index, then you'd need higher yields across the curve, a stronger dollar, wider credit spreads, and lower stocks. However, the real world is rarely that simple. And if we look at current levels versus late 2017 or pre-pandemic 2020, it is clear where the mispricing exists. Yes, we'd need higher rates, with 2-year yields at around 1.45% and 10-year yields at around 2%. But the biggest correction would have to occur in US stocks, where the equally weighted S&P would conservatively need to fall 30%. The point is, nothing can happen in a vacuum, devoid of fundamentals forever. The share markets are reading this right now, and these repeated heavy red days on share markets, so absent for so long, may be the start of the sort of correction Julian is talking about. Some of this will be covered in rotation from tech-heavy growth shares, so dominating indices into value shares, particularly commodities shares. But the sheer scale of overvaluation and growth would still mean big falls in the indices that are so passively invested. Julian concludes as such. My bias is for a bearish growth value rotation, and I fully expect year-end developed market stock prices, especially US tech, to be materially below where they are now. The US dollar will be lower, and gold and silver will be higher. Bonds will go down, but up in yield first, and then up later with a vengeance as the Fed becomes pro-cyclical. This roller coaster of a year has only just begun. And we leave you today with a tweet from one of our favourites, Ottavio Costa, He tweets, "Bring it on. The gold to S&P 500 ratio looks to be breaking out for almost a year-long downward trend. This is my 2 cents. This is the beginning of a move and not the end of one." Great little chart there. Remember, jump over to anzbullion.com.au for all things physical and also all our news. You can check out our charts. Buy gold, silver, and platinum. ainsleywealth.com.au for all things cryptocurrency. And of course, goldsilverstandard.com, our own crypto that's built and backed by real gold and real silver. Enjoy your Thursday, everyone. We'll catch you tomorrow for end of week news.